Well, stocks rose to fresh record highs last week amid signs of a sector rotation on Wall Street as Treasuries rallied and the dollar declined after cooler than expected US inflation figures cemented the case for a September Fed rate cut. There's plenty more on the horizon this week for traders to get their teeth into, with the ECB deciding policy, a busy UK data docket up ahead, including the latest inflation and labour market figures, and Q2 earnings season steps up a gear as well after the banks kicked things off on Friday. Plenty for us to discuss on the trade-off this week. Without further ado, let's get into the show. Well, it was a busy and volatile week in the markets last week, with the inflation figures on Thursday shaking things up. And joining me to try and make sense of everything that's going on, as always, is my good friend Ryan Littlestone from Forex Flow Live and Forex Analytics. Ryan, a very good afternoon to you. As always, we're filming this on Monday afternoon. Have you got over the crushing disappointment from yesterday evening just yet?
Nope. Short word for it. No. Well done to Spain for scraping a lucky win, and must try harder on our report card, I think, for the next time.
Yes, indeed. I think what is it? So it's going to be, hopefully in 2026 it'll be fifth time lucky, although whether Southgate is at the helm or not remains to be seen. But I think most definitely the better team won, I think is safe to say.
Well, it depends on your perspective, the way some of their players were rolling around and falling over, Let's move on quickly, shall we?
I was going to say, I feel like we could open a real can of worms there. Getting you started on West Ham is bad enough. I think getting you on England could be about 100 times worse. So let's get into topical thunder and get back quickly to safer ground in. Well, safer ground indeed is going to begin with a look at last week's US inflation figures, because, of course, we had that much cooler than expected June CPI print last Thursday, which has really, in the market's mind at least, cemented the case for the Fed to deliver the first rate cut of the cycle in September, and should give policymakers further confidence that inflation is indeed returning towards that 2% target. Although, of course, that must come with the caveat that the Fed are measuring that yardstick using the PCE inflation metric, which is due in a couple of weeks' time, and maybe just a touch hotter than the CPI figures that we got last week. In any case, on the month, headline CPI fell by 0.1%, which is the first month-on-month deflation since all the way back in May of 2020, when, of course, the global economy was in the midst of the coronavirus pandemic. And on a core basis, when you strip out food and energy, CPI rose just 0.1%, which is the slowest monthly rise in core CPI since back in February of 2021. When you look on an annual basis, headline CPI rose 3% year on year, which is its slowest pace in 12 months, while core CPI rose 3.3%, which is its slowest pace since back in April of 2021. So a lot of lowest since and slowest since there, and all of that in the market's mind has given the green light for a cut, and a cut very, very soon indeed, with the OIS curve now discounting around a 95% chance that the Fed do indeed kick off the easing cycle at the September meeting. And of course, continued signs of cracks emerging in the labour market, with unemployment having risen to 4.1% in June, are also cementing that case. Although it is worth noting that the curve does now price around 60 basis points of easing by the end of the year, which does seem a little bit punchy, particularly when you bear in mind that that median dot, although it is finely balanced, only points to 25 basis points worth of cuts before 2024 is out. Nevertheless, my view remains one that it has done for a while, that the Fed will begin easing in September and then probably deliver another 25 basis point cut in December, as long as inflation does indeed continue to behave itself. And with the Fed put still alive and well, I will be staying long risk for now. And Ryan, I get a feeling you want to bash the banks based on some of your tweets last week and how much their central bank forecasts have been changing recently.
No, I'm going to leave those alone. They're bad. Otherwise, I'll get stuck into those like I would have in England. No, I want to pick holes in this CPI data. A lot's been made of it. It's 13 months above 3%, 13 months with a 3 handle on CPI. So I don't care what anyone else has said. We had Feds Goolsby, banging a victory drum, saying this is what inflation moving to target looks like. It's 13 months with 3% or 3 handle on it. Until I see a 2 handle on it and then see a mid 2% on it, it's still sticky, in my opinion. Wages went up year on year, weekly earnings went up, year on year, hourly earnings went up in that report. And wages is something that the Fed have been talking about as well. So they were high in that CPI. Then we got the PPI on Friday. That went higher than expected by quite a chunk as well. I'm calling into question the market's dovishness around these numbers. You're quite right. It's gone a bit too far, running up, nearly 3 cuts now for 2024, where they struggled to get 2 cuts in predictions recently. HSBC, in March, I think it was, they were favouring June and then moved to August, then they moved back to June, and then now they've moved to August again, and then they moved to November. So, I think they've only got a couple of months on the calendar that they haven't picked so far for a Fed rate cut. So there's still time for that yet. I think the market's gone too far with this. Does it mean that inflation isn't going down? No, of course not. But I've already seen some of the propeller heads, drawing up their numbers for PCE. And as you said, it looks like PCE might be going higher once you factor in all this data. So we're not there yet. The market is desperately looking for when the Fed's going to cut. And yes, September might be in the frame. I think we can rule out the next FOMC. September largely in the frame, as said, but we have to wait and see what the data does. Even that jobs data, it wasn't a collapse in the jobs data. The numbers were still pretty high in terms of the headline NFP. Okay, unemployment rate ticked up. Who cares? It's been around that 4% mark for forever. And wages, again, still around that 4% mark, even though it came down a little bit. So I'm not as inclined to get as dovish over this US data as some in the market, but other areas are flagging some real weakness.
Indeed, yes. And we'll get into the policy outlook a little bit more in just one second. But I can get you a 2 handle on CPI, Ryan, if we go down to 2 decimal places where it was 2.98%. So, maybe you'll be a little bit happier now you've got your precious little 2 in.
Oh, you've become one of those. Everyone's, working their way down the percentage points now and past the decimal point to try and fill their rhetoric and make them right. I don't care. It says 3%. It said 3% when it printed. That's all I'm worried about.
I must admit that is bloody ridiculous, to be completely honest with you. Let's be frank. I mean, doing it to 1 decimal place is more than precise enough, and I do agree. But it does seem, certainly from what Chair Powell was saying last week in his congressional testimony about how the risks to that dual mandate are coming much better into balance. That does seem to just push the door ajar to easing sooner rather than later. And of course, Powell is actually due to speak between us filming this and it going out. So we'll have some more comments from him due very, very shortly indeed. In any case, let's move on. And firstly, congratulations on your musical pun, which Kyriakos very, very nearly edited out of the show for you.
Yeah, completely nearly torpedoed that one. That would have been a bit embarrassing trying to explain the pun in this one, but I hope at least a few of the oldies might get the reference for this one. It seems by luck or by design, some of these major central banks are happy to scoot off onto their summer holidays, leaving rates unchanged until they get back. The Fed and ECB have meetings in July, but signals and the data from those two suggest zero monetary policy changes. And the market, as we've been saying, is setting its sights on September, respective September meetings for both the Fed and the ECB. Now, the Bank of England do meet on the 1st of August. And last week, we finally got some members speaking after their sort of election hiatus. And Haskell, he gave no real indication he was ready for cuts. Peel was on the list as a potential close cutter in June. Even he was still pretty coy about whether they have the conditions in place for a cut. Catherine Mann, she was her usual hawkish self, no change there. And then on the other side, over the weekend, we've had Arch Dove, Dingra, popping up to push her rate cut case. So we're still left guessing regarding the BOE who are the remaining members are going to indicate the possibility of an August cut. Who were those near flip-floppers in the June meeting? If we don't hear anything from the rest of them, then the BOE will probably join the rest in the September brigades. And Obviously, as Michael's mentioned, we've got important data this week that could maybe swing whether it's going to be August or September. Inflation on Wednesday, jobs on Thursday, and retails on Friday. So a lot to look forward to as far as the UK is concerned. After that, the only other time we may get some clarity over these September meetings is going to be Jackson Hole in the US, the Economic Symposium, August 22nd to 24th. So that will be keenly watched on the calendar.
Yes, indeed. Jackson Hole coming around again. It feels like that comes around quicker every year at this point. I agree with you. Obviously, we hear from the ECB this week. They're not going to do anything. I don't think the ECB ever want to really do much at their July meeting. They would much rather not rock the boat too much and then all disappear off to the Med or wherever they're going to their sun loungers for their 6 or 7 week summer break. And as you say, see us in September when not only will they be back refreshed from their holidays, but also with the latest round of staff macroeconomic projections as well. And I think that's the same case with the FOMC. Of course, the September meeting is when we get the next SEP from the folk over in Washington, DC. And I think you're starting to see this become a little bit of a theme, actually, in terms of central banks wanting to normalize at a relatively gradual pace, i.e. a quarterly pace, and wanting to do so at meetings when they produce economic forecasts. And that is one of the reasons why, despite the perhaps more hawkish than expected comments that we heard from a few BOE policymakers last week, particularly Chief Economist Hugh Pill, that's why I think that the case is still relatively strong for the BOE to deliver that first cut next month. Although I must admit, it would be pretty interesting if we were to get a situation where the BOE were to cut, but you've got the governor on one side of the vote and his chief economist on the other. I think it could be quite difficult to explain the communications around that one. But nevertheless, I think before the tail end of summer, the BOE are really the only central bank of any particular interest until we get to Wyoming in late August.
Yeah, exactly. And you know, as we've been saying for a long while, we're just trading the calendar here. And so, you know, whether they go in August or September isn't going to make a huge amount of difference. It will do in the short term because, you know, just for the pricing of August versus September. But yeah, it's still a case of when, not if.
Yes, absolutely. Right, moving on to the yen. It's odd for me to speak about the yen on this program. I even had to send Ryan a text earlier to ask for permission to discuss the subject on my own program. But anyway, we're going to do a bit of a role reversal this week because it feels like last Thursday was when everything happened last week. Not only did we have that CPI report out of the United States, but the Ministry of Finance also rang up the trading desk at the Bank of Japan and they were told to get their hands dirty on orders from outgoing currency chief Kanda, with dollar yen rapidly falling about 4 big figures to a low just beneath 157.5 in the aftermath of the US inflation figures. Obviously, the move started and was relatively modest when that data dropped and then accelerated to the downside very, very rapidly indeed. It looked and it felt like intervention at the time in terms of the speed and the size of the move. And then it was confirmed by reports later in the day by both Asahi TV and Nikkei reporting that the Ministry of Finance had indeed stepped in. Two things we learned there. One is that they had indeed intervened, and two is that Asahi is not just a brand of beer, it is also a TV station in Japan. The BOJ's daily money market data then on Friday morning pointed to around 3.5 trillion yen having been spent in that intervention. And I think that's a little bit of an interesting one that's perhaps gone under the radar because that equates to somewhere between $20 and $25 billion, which is about a third of the size of the intervention that we saw back in April. So perhaps the Ministry of Finance keeping some of their powder dry there. And I think it's also interesting the timing of that intervention, once again, trying to get the most bang for their buck. Previously intervening in very, very illiquid times, this time intervening once the market had already started moving in the direction that they wanted to move in. So therefore requiring less to be spent. Now, of course, the usual caveats around the Ministry of Finance focusing on the volatility in the yen and whether the moves are deemed speculative continue to apply. They're not necessarily targeting an explicit level in dollar yen or euro yen or whatever it may be. And actually, it's interesting that on Thursday night, they were reportedly rate checking euro yen, which is not something we've seen this cycle. And of course, the risk for those who are still short yen, which from a macro perspective still makes sense, but the risk risk still remains that the Ministry of Finance are wanting to step in and seemingly very, very strong and resolute in their desire to stamp out speculation to as high a degree as they can.
Yeah, very much so. And I was thinking we were getting very close to intervention. That morning I was looking, the Bank of Japan, they run this near index, nominal effective exchange rate index, and they use it as their gauge for overall yen strength or weakness, and it's been hitting all-time lows, 74, 77 I think the index got down to. And I was looking at it that morning and seeing all yen pairs weakening, all yen weakening in a lot of pairs, a lot of the crosses, but dollar yen not really following. And I actually wrote in our chat room that morning that if the dollar yen catches up, if this CPI data is hot, even if it's not hot, if we see that rallying after, I think we're really in intervention mode. And it seems that the Ministry of Finance had the same idea, really, because, as you say, they decided to kick it. And I think they would have kicked it if the CPI data had been hot and seen a rally. I think it was blatantly, obviously, now that they were ready to hit it either way. And like you say, they decided it was easier to push on an open door, half open door. And I think that's the reason why we haven't seen as much intervention in monetary wise as we did in the last one. I think the first round was in April, May was 5.5 trillion yen. So, yeah, they didn't need to hit it as much. And I do think that potential rate check in euro yen was very, very significant, because they don't hit other currencies when they're doing it in Japan. They only hit dollar yen. What they can do, though, if they want to broaden it out, is use their other agents in other countries to hit the currency in that country. So, example, they'll speak to their European agents to hit euro yen. And I think that was a very significant rumour, just to say we are ready to broaden this out if you keep pushing our buttons. For now, it seems to have done the job. We've not seen yen pairs rallying that strongly, and so I guess it's a case to wait and see. But I'm also getting a few vibes as we had in 2022 when they intervened back then, just at the top of the Fed rate cycle, just as inflation had hit that high. And we saw a really big move south after that. They managed to catch it properly then. So, I'm getting those vibes as well. But as always, watch this space.
Yes, indeed. And also watch the next BOJ meeting, which, of course, is on the 31st of July, I believe. It coincides. That's actually a very, very busy period. I know we were talking about September earlier on, but the 31st, we've got the BOJ in the morning, we've got the Fed in the evening, London time. And then, of course, on the 1st of August, we've got the BOE as well. So could be a little bit of an interesting one there, particularly if dollar yen continues to move to the upside. In any case, let's stick in Asia, because you want to discuss China.
Yeah, China, still lots of problems over there. But as we know, they sort of have their own brand of solutions. What they've done in the banking sector.
That's one way to put it.
Yeah, exactly. I'm being polite here. I don't want to tick those guys off. I'll leave that to you to insult other countries as you usually do. But they've decided to step in again, jumped in consolidating their own banking sector. They've just recently, just off the cuff, decided to fold 40 banks with sort of bad property exposure into larger institutions. That looks set to continue, and that's the usual China fix of if there's a problem, make it disappear completely. Then we have the data, which is still showing some weakness in inflation in particular. And just this weekend, we saw a downside miss in Q2 GDP numbers, quarter-on-quarter numbers coming in at 0.7% versus 1.1 expected, and the prior 1.5%. On the year-on-year basis, it came in at 4.7% versus 5.1 expected. And that's well below the China's state target for the whole year. So they're going to be needing to look at that. Retail sales, they came in positive, but were much lower as well. So a little bit of weakness creeping there still. There was one surprise last week as we got to the trade balance data, and we saw exports ramping high, really big jump in exports, while imports surprisingly went negative. They were expected to come in up 2.6%. I think they came down minus 2.2% or 2.5%. So that was a real turn in those imports. We still obviously have the geopolitical tensions bubbling. Among the latest are these EU tariffs on Chinese electric vehicles, which China are still going to be responding to. So that makes this week's events in China very important, as Xi is holding his what's called the third plenum, which is a big state meeting which comes regularly, sort of every 5 years, and it's a meeting where they will decide the direction for the country on all major fronts. And things like in China, not looking great. There's a lot of attention on this one in terms of what big policy changes Xi might pull out the hat to get things going again. This meeting will be big for economics, for geopolitics, so headline watching is going to be a big must this week.
Yeah, I've got some paint that I need to watch dry instead. I think that might be a little bit more interesting.
I don't know why I bother. I don't know why I bother doing these segments. Really, I'm giving some guidance here to our traders, and you just want to fall asleep.
Oh no, it is important, but I mean, the data's all made up. The plenum will just be headlines and rhetoric that never comes to actual fruition. And personally, I still of the view that I was earlier in the year, that there are deep-seated and deep-rooted structural issues in China, which are, as you alluded to, still yet to be solved. Deflation remains a big risk, and the economy, and certainly many pivotal sectors of the economy, are still very, very highly indebted indeed. And I think if you are wanting Asian exposure, Japan, India, maybe even somewhere like Vietnam, remain much, much better options over the medium term. And certainly in my view, any rallies that we see in either the currency or in equity are there to be sold into.
Yeah, well, the currency is going to be important. You know me, I like trading dollar yuan a lot. I'm actually long at the moment. I'm wondering about my position, just because if they do bring some big policy changes, it should be the balance. On balance, I think anything that they decide that's good for the economy is going to see the yuan strengthen. So I'll be on the wrong side of that trade. But again, they could just give us some clean hints what they want to do with the currency. And if they do that, it's something to listen to, because you don't get many central banks that are as clear on what direction they want their currency to move in. And that's good for us trading it.
No, indeed. And I know that pair is yuan that you really like trading. So. Sorry.
There was me before the show bemoaning your lack of puns over some tweets this morning, and you've gone and where's my red card?
Mate, we had a week off. We've got time to make up.
I haven't got a red card. I'm going to show you that. There we go.
Oh, right, there we go. Ryan's going to do that to set up. Let's move on. Right, indeed, we are going to look at some charts, and I'm going to start with gold. Gold trading to its highest level since the middle of May on Thursday, after the inflation figures that we had out of the United States. And I think the interesting thing this time around, with the latest move higher that we've seen over the last week or so, is that in contrast to the rally that we saw in the first quarter of the year, where Treasury yields were moving higher and the dollar was strengthening, the latest move higher that we've seen in the yellow metal has been one where those fundamentals are a little bit more aligned with the rally. Obviously, Treasuries have rallied across the curve, although we have seen some weakness begin to creep in as the new trading week gets underway. And the dollar has, of course, traded relatively soft since that CPI print. Now, of course, we remain in this sort of broad $2,300 an ounce to $2,420 an ounce range that we've been in for quite some time now, 3 or 4 months. But if we were to get a closing break north of $2,420 an ounce, which I think will be a relatively tough nut to crack, then that could perhaps put the bulls in the driving seat a little bit more and put a test of the prior all-time highs on the cards. And as long as we do see Treasuries continuing to rally, and if the dollar remains relatively soft, then I would be tempted to be buying dips here, so long as we remain north of that 50-day moving average, which as always is the pink line on the chart there, around $2,350 an ounce. But of course, if we were to make a closing break below that, then I would be reassessing that view. But I think gold is an interesting one that could perhaps be primed for a little bit of a breakout here.
Yeah, an interesting one with this one is that we've heard that China apparently haven't been buying gold, which was
we're back
suspicion.
On that again, are we?
We're back on that again. Yeah, I mean, that was a basis for a lot of the rally that we saw, earlier in the year. But there have been some other headlines. There's been a few African countries who are apparently stepping in. I don't think they've got the beans to run this up another 1,000 ticks, but still that gives some buying impetus to it. So this one looks like it's moving more on what's going on in the fundamentals than it was before when we had that big rally up through 2000 and so on. Yeah, your levels are pretty solid. 24.20. I've just looked at my chart, and I mentioned it again in our chat room this morning, looking at the chart, and we've hit that pretty much on the head as we film this. So 24.20 is very important. Get above that, we need to take out that 24.50 high, and then we should be motoring on towards 2500. And you're right, if we're back below 2400, 2390 in the interim, that potentially puts us back in the box and keeps the range in play, and maybe have a look to the downside after that. But yeah, I like what you're selling, Mr. I forgot your name now. See, I know you like what you're selling, Michael. And probably I've got your surname already.
Brown.
And that's it, Mr. Brown. How can I forget that? See, old age. But yeah, I like your thoughts on this one, and it's definitely looking a bit bullish at the moment.
Thank you, mate. Applications for a new co-host on the trade-off are now open. Send your CV, 70 Gracechurch Street, Pepperstone. As long as you spell my name right on the envelope, then you've got half a chance of getting the gig. Right, Mr. Whatever your name is, let's have a look. We've both turned into Joe Biden, haven't we here? Let's have a look. Let's have a look at Treasuries.
I don't know if I want to now. But yeah, I might forget your name again. Oh dear, sorry, mate. Very embarrassing. Yes, a bit of a Biden moment. Anyway, let's try and get through this section without mucking it up. So when talking about the fundamentals, we know where US yields go. The dollar is sure to follow, and we might be on the cusp of a big breakdown in both the dollar and yields here. Since we last did the show, the dollar has really taken a bit of a turn for the worse. Once again, we're in that situation where the market is hitting the dollar on any minor data point miss as it continues to hunt for that first Fed rate cut. Now, the Fed has cut trade, or, it's been a 9-month itch that the market's been scratching throughout this. So it's been going on a long time now, how trying to catch out when the Fed's going to cut. This time it might be finally on track, the market, to see when that cut is coming, if it's coming soon, just because we've seen this more broader weakness in US data. And in advance of that, yields continue to drop, and tens are trying to make their mind up around this big 420 level. It really has been a significant level for quite some time. And if we do drop through below it and hold below it, we're going to see the dollar continuing to drop. But I don't envisage we're going to see any sort of collapse unless the data really starts collapsing too. But it could be a bit of a grind south. And even if we get good data, I don't think any rally in yields or the dollar is going to last long at the moment. So for me, I'm seeing enough evidence from various sectors in the US economy that this real trend softness is starting to be seen. And for now, that softness is still soft landing softness. A lot of softs in there, I can tell you. But as usual, the market always likes to get far more bearish than it needs to, as we were talking about earlier. And that obviously can be reflected in price moves. If we do see a move south in yields, then you're going to look at pairs like cable, euro, dollar. They're going to remain well bid and keep rallying. So my question to you, with the market currently as they are we going to see my 111 soon, Michael?
Well, I hope not, because otherwise I've got a rather large lunch bill to pay once again, haven't I? So, you know what, I might end up having to just go long the euro to hedge my bets on that one at this rate.
Hedge lunch.
Yeah, exactly that. But I do want to talk about the dollar. You mentioned cable and some of the moves that we've seen there, and I think, certainly cable bulls are enjoying themselves of late. Spot cable trading to its best level in just over a year, and kissing that 130 figure on Friday, just shy of that level as the new trading week gets underway. But I think perhaps the market has got a little bit overexcitable here. The rally that we've seen has been built, of course, on two things: the cooler than expected US CPI figures that we had last week, plus that perceived dovish shift in BOE speak with Hugh Pill, as we mentioned earlier, casting some doubt on the idea of an August rate cut. But it is a huge week ahead for the pound, for the UK economy in general. And actually, in terms of that August BOE decision, I think this week's data is either going to seal the deal for an August rate cut or put many nails in the coffin of that idea. Of course, we have inflation due on Wednesday, labour market figures due on Thursday, and then retail sales due on Friday. Now, CPI is seen below 2% for the first time in 3 years, and I think if that is indeed the case, and we get a continued cooling in some of the underlying metrics, such as the services CPI print, then I think that should cement the case that the BOE do indeed deliver a rate cut in August, albeit with the MPC likely divided in terms of the vote split. But of course, the OAS curve here in the UK only pricing around a 50-50 chance of that August cut. So personally, I would be inclined to sell any rallies in the pound as we get closer towards that 130 figure, albeit with a relatively tight stop above, given the lack of any resistance between that and the highs from last year around 131.40. But for now, I think the risks are that the rally we've seen in cable is built on relatively shaky foundations.
I might have to disagree with you yet again.
Here we go
again. No, I think that the pound at the moment is seeing a bit of that exceptionalism again that we saw at various points this year. You know, every time we see a dip in the quid, it tends to get bought up, you know, a bit more than we've seen in the euro. So I think that's going to continue, but, you know, all these moves are going to have their limits. At the moment, 130 is the limit here. I think the data is going to be very important this week, as we pointed out, as you've pointed out. Rally sells, you know, it's a big level up here, 130. We've tried it a couple of times this morning and we've held it at the moment. So it is a big old level. My worry would be, where do we go if we do break it? It could be a pretty fast trip up to that 131 highs that you got on your chart there. But if the data goes the right way, you're going to see those August rate cut bets picking up, and likely seeing the pound dipping. But you know, the dip is going to be the thing to watch, I think. But I'm not going to say too much of that now.
No, I wonder why. Oh, now I know why, because I've got ahead in the script. Right, before we get there, let's have a look at dollar CAD.
Yeah, dollar CAD.
Come on, keep up. Come on.
Oh, God, blimey, you've got me on the back foot now. See, all flustered. Another big week for the loonie. We've got Canadian inflation data Tuesday or today, as you're going to be watching this, and it could be another big data point for the loonie this month. Last month, we saw a bit of a surprise bounce in CPI after it had been steadily coming lower. You may remember, you may not. The BOC core measure dropped from 2% in March to 1.6% in April, marking it as one of the first majors to print a one handle on inflation and getting the BOC all dovish on cuts. Then last month, it jumped back up to 1.8%, highlighting the use of bumpy as a term that many central banks are using to describe inflation at the moment. This month, inflation is expected to come out roughly unchanged to maybe a bit lower in a lot of the 25 measures that they like to use to count inflation. Excuse me. So for the dollar Canadian, we've tested and held a real humdinger of a support level around 135.85, 136, and we've been capped by another pivotal level around 136.50, though we did have a little break this morning. Now, that's a pretty tight range to sit in for too long. And so I think this CPI data, if there's a big variation, it could kick the pair one way or another. Now, I'm favouring the short side because I'm a bit more bearish on the US dollar. And I've got some long-running sell stop orders just below the 135.85. So if this 136 area doesn't break, though, I'll possibly be eyeing any rallies to sell just because I've got that dollar bearishness in the back of my mind.
Yes, I think it's going to be an interesting one this week. Actually, not only we've got a few inflation figures. You mentioned obviously the Canadian figures there. We've also got, just going a little bit off topic, inflation figures due from New Zealand as well. And we had that slightly more dovish than expected messaging from the RBNZ last week. So it'll be interesting to see if we see some more downside in the Kiwi dollar on the back of some cooler inflation figures down in New Zealand as well. So I think it could be a little bit of an interesting week in terms of economic data outside of the United States. The calendar of top tier releases stateside is a little bit lacking, but as I said in the intro to the show, plenty for traders to be getting their teeth into elsewhere, I think.
Yeah, very much so. It's going to be a good week, actually, looking at the calendar. there's enough data points that should be tradable, but it's not coming, 1 minute after another where you can't sit in a trade for longer than 5 minutes in case the next piece of data bites you in the backside. So, it should be good for at least picking some trends out.
Well, fingers crossed, and let's hope you haven't sort of put the kibosh on things there. In any case, let's get on to our plays of the day. Well, based on what he's just said, it sounds like Ryan's play is long vol rather than anything to do with cable, but we'll get onto that in a second. I want to discuss the dollar first of all. I'll keep things relatively short and sweet because, as you can see on the chart there, the dollar index has come all the way down to test the 104 figure, which is, of course, the bottom of the range that we've been trading in since the middle of March, which is broadly 104 to 106 and a half. This is a little bit similar to my cable view earlier, actually, in the way that I think upside there is a little bit overdone. I think some of the downside that we've seen in the dollar is probably a little bit overcooked as well, particularly with the market now pricing just over 60 basis points worth of Fed cuts by the tail end of the year. And of course, recognizing the fact that the US still looks like it's on course for a soft landing with growth. Yes, it's slowed, but it remains a hell of a lot rosier, the economic outlook in the United States, than it does in other developed market economies and in some of the dollar's G10 peers. So short and sweet, I'm buying the dollar dip right at the bottom of this range that we've been in for some time. I think that range is going to remain in place, and I'm happy to be scooping up the dollar right here. Ryan, I feel like you're going to take almost the polar opposite view to what I've just outlined.
Not quite, almost. And but there's actually two reasons why I picked cable as my play of the day. Firstly, most importantly, because I see it as a potential trading opportunity. But secondly, I think there's a lesson here too. You've already shared your preference for shorts into 130 here. So your bias is a bit more bearish, whereas I'm looking for a dip to buy. So my bias is bullish. The fact of the matter is that despite, seemingly having opposing opinions, there's a chance we could both be right. You could have that short view from 130 and run it right down into my long view lower down. And, I buy the dip, you sell the rally sort of thing. So we could both be right. And in trading terms, both make money. So that's an important lesson. I think you don't need to have, a different trade just because you've got different opinions. You can both make money on different opinions. So if the data this week sets up a cut for at the August meeting, I'll be looking to trade a dip maybe down to 128.50, 128, that big break point, as I think that continued dollar weakness would see that move reverse pretty quickly, as obviously the dollar trade is the far bigger one. Plus, while an August cut would be a bit of a surprise in terms of current pricing, it's not in the grand scheme of things, where still a cut is still a case of when, not if. So I'm looking for a nice dip to buy in this one and see it rallying back up again.
Good stuff. An important context as well. That does bring us to the end of another show. Thank you very much, as always, to Ryan Littlestone from Forex Flare Live and Forex Analytics for joining me, even if he did forget my name halfway through that recording. It's a pleasure, as always, to work out exactly what's going on with you, mate. Oh, God, let's not. Thank you very much, as always, for watching. I hope you've enjoyed the show. If you have, drop a like on the video, leave a comment as well. Let us know how you're trading the markets, or if there's anything you'd like us to discuss in next week's episode. And that is indeed when we will be back with another edition of The Trade-Off. In the meantime, have a very, very good week ahead. Thanks as always, and goodbye for now.